welcome to the show. Just a little warning for this show. If the cameras go out, we've had the Wi-Fi problems today. I think it's something to do with the weather or Murphy's Law, but we'll just keep rolling because we record this live, and we'll just keep going and leave it on the PowerPoint.
That'll work.
All right, what you got for us this week?
I'll get the idea. It's been a heck of a week. So much conflicting data and people scrambling to try to explain what's going on. At this point, you're trying to catch a falling knife if you're thinking about getting back into the stock funds if you weren't already in there, and or you're on the roller coaster ride. I mean, it's quite something. Yes, Thursday was a huge down day based on tariffs that got announced on Wednesday, but by Friday, you got China already coming back with adding tariffs back onto the U.S. So at least it appears that the beginnings of a trade war are happening, and that's certainly not good for the stock market. There will be face-ripping rallies along the way. If you try to get in front of those things in your TSP account, good luck to you. Maybe you could have some luck in the mutual fund window, but I would do it with a very little bit of money. So we will talk about a few things, and really it's about kind of how to look at this, how to look at what's going on. So we'll talk about what happened this week. The biggest thing, obviously, was tariffs. It's kind of amazing how the economic data that's supposed to be so important that we talk about every week can get overshadowed by one big event or policy change. But FOMO versus the fear of continued losses, that's really the highlight, right? Everybody either is worried about not being in for when we get this big recovery rally, or they're worried about being in and taking more losses. So we'll try to give a little bit of guardrails around that. And then what does it mean in general to be on the right side of the market? And we'll take a look at the I versus the C fund for a minute and then the TSP fund charts. So Monday we get some pretty interesting economic data this week, right? Monday PMI was up to 47.6 from 45.5 last month, right? So anything below 50 is contraction, but it's moving in the right direction if it's at 47.6 versus 45.5. Dallas Fed Manufacturing Index dropped 8 points to its lowest level since July 2024. So business activity and sentiment are both kind of weakening, right? And then Monday, the S&P was up 0.5%. Tuesday, you get ISM Manufacturing PMI that fell to 49 from 50.3 last week. So on Monday, you got Chicago. That's that Chicago area. On Tuesday, you get Manufacturing PMI, which is a national number. So that's why there's the variation there. Again, anything below 50 is contracting. We also had the JOLTS, which is job openings, decreases to 7.57 million from 7.76 million last month, and the quits was also down. So according to that measure, employment is weakening, and S&P was up 0.38%. Then on Wednesday morning, we get 30-year mortgage rates dropped just barely to 6.7% from 6.71% last week, and new applications dropped 1.6% versus 2%. Last week. But the big news on Wednesday, obviously, was after the close when tariffs were announced. But on Wednesday, at the close, the S&P is up 0.67%. So at the beginning of the week, we're starting to kind of claw back from the last couple weeks of decline. And then Thursday, feels like it was a month ago at this point, but initial jobless claims were 219,000 versus 225,000 last week. So that's good. Continuing claims rose from 1.85 million last week to 1.9 million this week. But the big announcement obviously was tariffs from Wednesday night, and that drove Thursday's trading. The S&P was down 4.84%. Then on Friday, we had non-farm payrolls that added 228,000 new jobs versus 117,000 in February, and they only forecast for 100,000. So there's more than twice as many jobs created in March than they forecasted. That's a huge positive number for the economy. Okay, doesn't matter. It's getting completely overridden by this trade war and tariff stuff. Unemployment did tick up from 4.1 to 4.2%. But as of 10:30 in the morning when we started to do this, S&P was down 3.5%. So we'll see how it closes out the week. All right. So this is really, at least from looking at the Facebook group, this is kind of what I'm taking away from what's on people's minds. The fear of missing out, right? If the market reverses and starts moving higher, versus the fear of continued losses. So this is a monthly chart of the S&P 500. This is a 10-month moving average line. Okay, so imagine you're only looking at price once a month, and you have a 10-month moving average line as a guide. So back here in 1990, the 10-month moving average went below, or that monthly candle went below the 10-month moving average line. Stayed down there for a couple of months, and then ticked back up above it in late 1990. It stayed above that line. We got some support here in 94, right? But it stayed above that line until breaking down below it in 2000. Okay, so for about 10 years, it stayed above that line. And he had huge gains over that time. Once it broke down below that line, right, closed below that 10-month moving average line, the market collapsed for a 50% decline right there. Once it got back above, right, after that 2003 bottom, it got back above it. It stayed above it until 2007, until it got back below it again. Okay, and then we had a 55% decline. Okay, so what I'm trying to point out is there are, I don't know if metrics is the right word, but there are a couple things you can look at in the big scheme of things. Okay, when the monthly closing price gets below the 10-month moving average line, it's significant. It doesn't mean you have to move your money then, but it means you should be paying attention. Okay. The other thing I wanted to point out on this one was, this is 2000 at the top. This is a double top in 2007. And it took until 2013 to get back to even. So that's 14 years of sideways movement. So if you had $1 million here, not counting, continued contributions to TSP, but if you had $1 million here, and you held on, now you're back to $1 million here. You held on again, you're back to $1 million here. So you were flat for 14 years. Right. So obviously, when the monthly candle gets below that 10-month moving average line, something's going on. So the idea of fear of missing out versus fear of taking continued losses. So what I did here was the same exact chart. It's 1 month of the S&P 500. And the bottom of this is when price got back above the 10-month moving average line. Okay. So from 1991 to the top in 2000, you got a 367% gain. Okay. 367% in whatever that is, 10 years. That was a huge move, right? One of the best bull markets we've ever had. Then the market pulls back 50%, and then you had, from the time we got above the 10-month moving average line again until we got to the top in 2007, you had a 70% increase. Okay. So if you had looked at this and you're like, all right, I just made a 367% gain over the last 10 years. And I can see that this month closed below that moving average line. Maybe I should think about locking in those gains, right? Why would you want to do that? Because the last time we got below that moving average line We had some pretty big losses for a while. Only 2 months down there, right? But we just had 10 years above that line, and now we're below it. So the question is, am I locking in almost 367% of gains, or am I locking in these losses right here from the most recent all-time high to where you would have gotten out right there? Right? That's the question. Do you look at this like I'm locking in my gains, or I would be locking in losses if I got out there? There's no right and wrong answer to it, but that's how you should think through it that way. This is where you were, right? If you were at the top trying to make this decision in 2000, the market declined 15% by the time that 1 month candle closed below that 10-month moving average line. So not too dissimilar from where we are now, right? We're down, whatever, 10, 12% as of today, who knows? But something like that, right? So everybody's thinking, I can't reallocate to the G fund now because I'll lock in my losses, okay? At this point, if you had, quote unquote, locked in your losses at minus 15%, you would have saved an additional 41% of losses. And then the same thing in 2008, from the peak, the market was down 12.79%. Had you locked in those losses, you would have saved yourself from losing 51.44% additionally. Okay? There's no way to know that this is happening in 2025. Absolutely no way to know it. But it's obviously a possibility. So where are we? This is as of Thursday's close. It's not even counting the market action on Friday. So we had 2 consecutive monthly negative candles. In March, we closed at the bottom of the monthly trading range, below that 10-month moving average line. Okay? And at that point, at the end of March, the market was down 8.78%. So if you had reallocated to the G fund, this candle right here is April. It's only a couple of days, so kind of disregard that. You would have locked in an 8.78% loss from the February 19th all-time high. If we get something like 2000 or 2008 and the market keeps going down, you will be very happy with that 8.78% losses locked in, especially if you had these gains over the past couple of years. So it's perspective, right? If your perspective is always from the most recent high, that's where the fear of missing out comes from. If your perspective is from, I've made all these gains, then your fear of continued losses, that's where that comes from. But the key is to use technical analysis so that you know which price movements are significant, right? These don't matter, right? These down months don't matter because they're not crossing important thresholds. This one mattered, right? Okay. Hopefully that helps a little bit with fear of missing out and gives you guys some things to think about. So just in general, what does it mean to be on the right side of the market? You're on the right side. Being on the right side of the market depends on your time frame, what you're talking about, right? If you're looking at a monthly chart, so I like to use 20 period moving average lines. You don't have to use 20 period. You can use 50, 100, 200, 10 periods. If you pick a moving average line that shows support at the major bottoms, right? That's kind of what you want because that's what the price is respecting. So as you kind of scroll through and try different moving average lines in TradingView or StockCharts.com, that's what you're looking for, a moving average line that works with the time frame that you're looking at. So if you put a 20-month moving average line on a monthly chart, as long as the line is moving up and to the right, the trend is up, right? When price gets below, that's when bad things are happening, right? So if you're looking at the chart monthly, you don't want to be in the stock funds below that 20-month moving average line. And you get some whipsaws, right? A little bit, you're definitely going to get some whipsaws. It's not perfect. If you're following if you say you're managing your TSP account on a weekly basis, a 20-week moving average line is pretty good. This was a big one in 2018, right? We closed below that 20-week moving average line, did a range-bound consolidation, stayed below it for months, and then a big drop into the end of the year. COVID, that first week, dropped through it and then did another 30% decline to the bottom, right? Same thing with 2022. We had a huge move up in 2020 and 2021, and then once we broke down weekly through that 20-week moving average line, it was the beginning of this 25% decline. This one was a reversal, right? It didn't work. It didn't work, meaning it's no big deal. It didn't keep going down. You would just get back in, right? And here we are right now. That week, we closed below that 20-week moving average line, and we've been going down ever since. The weekly is a good weekly, and the 20-week moving average line is really good. If you want to expand it out a little bit more, the 200-week moving average line, okay? So you're giving yourself a whole lot more room, but since the bottom in 2009, we have all this support at that 200-week moving average line. We had a little bit of an overshoot in COVID, but for the most part, since the bottom in 2009, every time we've come down to that 200-week moving average line, we've gotten support there. So when price gets back down to the 200-week moving average line again, the odds favor we would get some support there. If we don't, if we break through there and support fails, right? This was more than half of the decline from 2000 to 2003, and way more than half of the decline in 2008 into 2009. So just because we get down here to that 200-week moving average line, I mean, people will think, you'll hear all the stories about it has to be the bottom, everybody's fearful, you're supposed to be buying when everybody's afraid, and like all that. And it may end up being true. It was true here, and here, and here, and here. And it was not true here and here. All I'm saying is they are decision points. They're not, no one's telling you what to do. They're decision points at which point you have to make a decision. And then the daily 200-day moving average line, if you're following the market daily, as long as you're above, and the 200-day moving average line is great. Whenever we get down to it, we generally get support at it, right? When you break down below it, generally bad things are happening. And we've been below it here for a minute, and it continues lower. All right, quick one on the I fund versus the C fund. So we talked about this a few weeks ago, but it doesn't really matter that much now because like everything rolls over. So this week, the I fund rolled over, gold, all the commodities, Bitcoin. When the market tanks, everything tanks with it. And so this is a ratio chart of the I fund versus the C fund. Okay, so when the I fund is outperforming the C fund, the line is going up. When the C fund is outperforming the I fund, the line's going down. Okay. So we have a couple well, in general, the line's been going down since 2009, 2008. Okay, so in general, the C fund has been outperforming the I fund for a long time. But we get these little upticks, right? If you can catch those upticks, they're pretty good. That's assuming that the I fund is actually going up, because this is a ratio chart. So if the C fund is going down, but the I fund is going down less than the C fund, the line would still be going up, but it doesn't mean that the actual number is going up, right? It's a ratio. So we had a little uptick at the beginning of the year. and it looks like it's starting to roll over, whatever, but everything is going down at this point. So it's entirely possible that this line continues higher because the ratio, right, the I fund can be outperforming on a relative basis, but not actually going up in terms of numbers. The other thing that's important, I thought was pretty interesting out of this, most of the time when the ratio is at a bottom, so the I fund versus the C fund, when the ratio is at a bottom, it's a bottom for the S&P 500. This line on the below here is the S&P 500. So when the ratio bottoms, the C fund is at a bottom and starts moving up, right? The ratio bottoms, the C fund's at a bottom. The ratio bottoms, C fund's at a bottom. What's kind of interesting, I think, and I don't really know why, but it's kind of interesting. This bottom in the ratio was a top in the C fund. Okay? It's an outlier from the other ones. Because in all the other ones, we had a bottom in the ratio, and it was a bottom in the C fund. The C fund was moving higher. In this one, we had a bottom in the ratio, but the C fund started moving down. And that's also what we have right now. We had a bottom in the ratio, right? And it's a top in the C fund. The C fund's moving down. So interesting, definitely to keep an eye on. They say when the U.S. sneezes, the world goes into recession. Well, when the U.S. goes into recession, I don't know what that means for the rest of the world, but it cannot be good for the I fund. Okay, TSP fund charts. So this, again, does not count Friday's price action. And this is a weekly chart of the C fund. Each tick is 1 week of price action. The black ticks are up days. The red ticks are up weeks. The red ticks are down weeks. And the relative strength indicator here. The blue line is the 20-week moving average line. Kind of like what we talked about before. Once you get a weekly close below that blue line, you don't want to be in the stock funds, right? There's no guarantee how long that will last. We had that right here, and then we only had one additional week of decline, and the market did a V-bottom and kept going higher, right? That's fine. We also had it back here several weeks ago, and the market's gone straight down ever since. S fund. This is an ugly looking chart. And the S fund's down another like 5 or 6% today. So, I mean, we're going to be, if we close the day, close the week down here somewhere, you're talking about all the gains going all the way back to sometime in 2023 being wiped out. I fund, again, like we said, it had been holding up better than the C and the S funds, but it's been a tough week for the I fund too, and we're going to be down here somewhere by the end of the week, so we're just back into some kind of trading range on the I fund. And then the F fund is of all the asset classes, and if you've been following the podcast and certainly the newsletter for the past couple of months, we've been talking about the F fund quite a bit because when investors flee the stock funds, most importantly, when there's some kind of big existential event going on, can be a pandemic, can be a sovereign debt crisis, can be anything major that's going to affect the credit markets in the world. You get a flight to safety, and the flight to safety generally goes to long-term treasury bonds. And a good chunk, not all of it, but a good chunk of our F fund is made up of long-term treasury bonds. And so as long as this uncertainty is still there, and it looks like it's going to continue for some amount of time, as long as that uncertainty is there, investor flight to bonds will continue. And it's the only asset class that's going up. Gold is down 2% right now. Silver's down, copper's down like 6% just today. Everything is tanking, and investors are fleeing to the safety of bonds. So that's what's happening. And the G fund goes up and to the right. However, if the thing about the G fund is as rates come down, the rate of return that you get on the G fund goes down. You never lose money, you never lose any principal, but the amount that you gain goes down as interest rates come down. So it's 100% security in the principal of your what's in your TSP account if it's in the G fund, but the amount that you gain goes down. The other thing that's really interesting this week is oil. So when the price of oil goes up, it's almost the same as saying inflation is going up. When the price of oil goes down, inflation is coming down. It's because demand, right? There's much less demand for stuff. The price of oil comes down. The price of energy comes down. And oil has fallen like a rock this week. And it was already, I don't have a chart of it, but it was on a big flat shelf, and it basically collapsed through the bottom of that shelf. So on the one hand, when they say that tariffs are inflationary, which is the big talking point right now, yes, in a silo, tariffs are inflationary. But when you look at the price of oil collapsing, inflation is going lower from here. It's not going higher. That is all I got.
All right, questions. As always, if you have questions, put them in the comment section wherever you find the video. And if there's no comment section, you can always shoot us an email at support@growmytsp.com. And a lot of things to be thinking about, a lot of reasons to watch this show each week because it's not going to stop being chaos for a while. All right, guys, hope you have a great weekend, rest of your weekend and the week. We'll see you later.